Greetings, great sport learners. My name is Mr. Simbi, and welcome to today's accounting class. This lesson is brought to you by the Gauteng Department of Education in collaboration with Sabono Discovery Center. It is that time again, every Friday at this time, we're going to be having class. So make sure that you don't miss these classes. Very important. What are the things that you need for the class? You need a pen or a pencil. A calculator is very important, and obviously you're going to need somewhere to write. You need to invite your friends and tell them that the accounting class is on. All right? If you're ready, let us begin. Here are my objectives for today's class. I'm going to zero in on three things. The first one, I'm going to touch on what is the AGM. In every class, I'm going to be touching on specific concepts that relate to accounting. So in today's class, I'm going to speak on what is the AGM. We are going to complete the statement of comprehensive income together, and we're going to touch on some notes that pertain to the statement of financial position. In the previous classes, which you'll find again on this very same page, in the previous classes, I've done ledger accounts. In the previous week, I've also done the statement of comprehensive income, where we had some interesting adjustments. It is very important that if you have not watched these classes, please revisit these classes such that they may benefit you. In today's class, I will again touch on the statement of comprehensive income together with specific notes that pertain to the statement of financial position. All right, so we wanted to know, what is this AGM? Okay, the AGM, it is an abbreviation for the annual general meeting. So already you can hear this is an annual general meeting. Annual simply means a yearly thing. And this is a mandatory yearly gathering of the company's shareholders. Remember, who are the owners of a company? Shareholders. So they meet annually, yearly, that is so. And this is mandatory that they do so. And the agenda of an AGM will cover the following amongst others. So in today's class, I only speak about three aspects that will take place during an AGM. So when an AGM has been called for, the first thing, or one of the things that will be discussed in that AGM, is the financial performance. Remember that the shareholders are the owners of the company. So they would want to know, how is the company performing? So amongst other issues to be discussed at the AGM is the financial performance of the company. The second thing that I'll touch, that will also be discussed in this gathering, is to elect directors. You have to know that directors are elected, or they are chosen at the AGM. And who does that? It is the shareholders. They also elect our directors. And there are other matters that will be discussed. All right, these are significant matters that relate to the company's operation. So it is very important to know what is the AGM. All right, so that if it appears anywhere, we know that we have covered the annual general meeting. In next week's class, I'm going to cover again a certain concept that relate to our companies. Now that we now understand what is the AGM, we're going to go to the core business of today's class, that is completing a statement of comprehensive income. Are you ready? If you are, we're going to start right now. We are going to look at an activity, that is activity 1, which we have taken from the NSC June 2019 paper, and we're going to focus on question 4. Okay, so if you have this question paper, that would be good that you can also have it. When I do these adjustments, then you understand. But if you don't have it, that is not anything you should worry about. I have prepared these slides in such a way that you will see each adjustment, and we're going to do it together with you. So what I want you to do is to make sure your calculator is next to you, your pencil in hand, and then you have a paper to write on. So if you don't have this paper, do not even worry. You are covered because I have the paper for you. So I'm going to do it together with you. Are you ready? If you are ready, let us go. All right. It is very important that when you are attempting a question, you need to read the information that pertains to that question. And here we are told that it is MWVS Limited. The information relates to the financial year ended 31 March 2019. Very important. And this could also be a very tricky aspect. We are used to the financial year ending on 28 February. But in this question, they say the financial year ends on the 31st of March. This is of great importance. When we are going to be doing certain calculations, we have to remember that our financial year ends on the 31st of March. Can I ask you a funny question? When did this financial year begin? If it ends on the 31st of March, it means it had began on the 1st of April. You're correct. It had begun on the 1st of April in the year 2018. So until we get here, then we have one financial period, 12 months. So it is very important that when you are about to attempt, read the question and understand it properly. This financial year ends on the 31st of March, the year 2019. Required. This is what the examiner wanted us to do. To complete the statement of comprehensive income for the year ended 31 March 2019, and this is about 53 marks. And we're going to complete the notes to the balance sheet. That is your fixed tangible asset note as well as your ordinary share capital note. What number is the ordinary share capital note? That is note number 7. You're very correct. That becomes note number 7. If you're ready, let's begin. So we are given an extract of figures from the pre-adjustment trial balance as of the 31st of March. And you can see in this extract, we have the year 2018 and here we have the year 2019. So you have to understand that you were given an extract of 2 years, 2018, and we're moving on to 2019. So when we are doing calculations, you have to know which figures will you be using. Is it the 2018 figure or the 2019 figure? That will all depend on the adjustment that would have been given. Okay. And then adjustment number 1. If you're ready, we're about to begin. Let us go. Adjustment A reads, a credit invoice for 36,720 after deducting a 10% trade discount issued on the 31st of March was not recorded. Here's the key word, was not recorded. So this is an invoice. An invoice simply means we sold goods on credit. That's what an invoice stands for. That's what it means. Remember, it's a source document. We sold goods on credit, and this transaction was not recorded. Now, one of the key aspects in this adjustment is that there was a trade discount, a 10% trade discount that was granted. And then these goods are marked up at 70% on cost. All right. What are we required to do? We are required to prepare the statement of comprehensive income. We all understand that. All right. But when I do this, I am going to complete as well at the same time my trade and other receivables note. So we're talking note number 5, okay? Trade and other receivables. And at the same time, I'm also going to address inventory note. We're talking note number 4. So these are going to go together. Let us see how we can do this. The first thing I'm going to do is to record my sales. So I'm going to come here and then I'm going to have my sales here. So I say sales. One of the golden rules in accounting is to open brackets. Open brackets, very important. So I'm going to come here. I take my 10 million. I have my 10,563,000. 10,563,280. There I have it. Okay. So in this question, we were not given a debtor's allowances amount. Otherwise, I should have come and subtracted my debtor's allowances. But in this particular question, debtor's allowances were not given in the extra. But I should have come and subtracted it already. And then the next thing I'm going to open bracket, and here I'm going to have my cost of sales. So I'm going to come and say cost of sales. It is very important that you know that your cost of sales should be in bracket here at the end, okay? Because you're subtracting it. So if you want to say, you can say minus cost of sales, or you can say less cost of sales, because you are going to subtract your cost of sales to get your gross profit. And my cost of sales here is 6,236,000. Okay, and eventually this gives me what we call gross profit. There it is. Okay, then let us go on. We are told that we have a credit invoice for 36,720, and that was not recorded. When we sell goods, it will affect four accounts. In this case, we sold goods on credit. So 4 accounts are going to be affected. That means I'm going to come here and I'm going to adjust in 4 accounts. And for you to understand it easy, we talk about the diskette. Diskette, there is our D, our S, our C, and our T. Diskette. All right, because it is a credit sale invoice. And then the D stands for your debtors control. And once we sell, it is a plus. So we come here, it's a plus. And on our sales, it's a plus. On our cost of sales, it's a plus. And on our inventory, it is a minus. We are aware that the amount is 36,720. So I'll come here and I'll have my 36,720. This one was given. This is not a problem. Then we now need to know how much is the cost, therefore. All right. So for me to get the cost, I will now say we are given the sales after deducting a 10% trade discount. That means for me to get the original cost of sales, I have to go back to what was the intended selling price before the trade discount. And for me to do that, I would then say my 36,720. Then I multiply this by your intended selling price, which is your 100. But what we are given is after trade discount. That means I had the intended selling price and I have now taken off 10% trade discount. Therefore, I'm left with 90%. That is equal to the 36,720. So therefore, it means I'll come here and I will now say what I have is the 90. And then if I punch that in my calculator, that is going to give me an amount. How much are you going to get there? If you say 36,720 multiplied by 100 over 90, you are now going to get 40,800. So I'll come here and I have my 40,800. Then I'll take that 40,800. That is the intended sales figure. This is what we should have got if we had not given the 10% trade discount. So it is easy for me now to come back now to get my cost of sales. Remember, they told us that the markup is 70%. So here it is 70. And my cost is always what? 100. That means my selling price becomes 170. So this 40,800 is my 170%. But what I want is the cost, which is 100. Remember the cost, 100. And what I have is 170. So it would then give me the cost of sales for these goods that were sold. How much do you get on your calculator? Please punch these figures. 40,800 multiplied by 100 over 170. How much do you get? Thank you. You get your 24,000. That means I will come here and I now know that my cost of sales for these goods is 24,000. So what did I do? I was given a selling price after trade discount. I went back to get the amount before the trade discount such that I can calculate my cost of sales. That is how you would do it. Now that I have my figures, I will start adjusting. I know that if I have sold goods and that transaction is not recorded, I'll start off first with my D, that is debtors control. So I'll come here to trade in other receivables. So I'll just say debtors control. This is my debtors control. And I'll open my bracket. I'll take my 578,000. There it is, 578,000. What do? Then I add, remember, that's a plus sign. I add 36,720. Then I say plus 36,720. We have more debtors in this case because we have sold more goods on credit, yet that transaction was not recorded. So we have more debtors. Our debtors increases. We have sold goods and it was not recorded. That means our sales are more. So we come to our sales and we say plus 36,720. Are you still following me? Okay, so we come now. So we have done that. Remember, disk it. Then we come to the C and we say our cost of sales is actually more because we have a sales that was not recorded. I'll come and then I say plus 24,000. We then come to our inventory. Here we have trading stock of 364,200. So I'll come here, then I'll say my trading stock. According to the records, we are supposed to have trading stock of 364,200. However, there are sales that we did that were not recorded. That means those goods have gone out of the business, yet that was not recorded. That means our trading inventory must be adjusted down because we have sold goods, yet we did not record that transaction. I'll come in, then I'll say minus 24,000 because we have sold goods, yet we did not record that particular transaction. Very important. Do you see what we have done here? Okay, so this is what happens when you have sold goods on credit and the transaction is not recorded. And more especially if there's a trade discount. You calculate back to the intended sales figure. So then you can calculate your cost of sales. But in your sales and debtors control, you record the amount that you are given after deducting the trade discount. If we're good, let's go on. So I'm going to go on to the next adjustment. My next adjustment, but before I go on to the next adjustment, let's close the bracket. Let's close the bracket. Let's just close the bracket. So I'm going to say the 10 million plus the 36,000. How much do you get? I need those figures. 10,563,280 plus 36,720. How much do you get? Okay, you get your 10.6 million. That is 10,600,000. Are we still okay? All right, then let's come to the cost of sales, which is your 6,236,000 plus your 24,000. That is going to give you 6,260,000. 260,000. Now, the last figure, which is your gross profit. So you're going to say this minus that. That is going to give you how much? 4,340,000. 4,340,000. Let's go on to the next adjustment then. That is going to be adjustment B. There it is, adjustment B. Adjustment B then says the physical stock count on the 31st of March 2019 reviewed the following on hand. You have to understand that for every business that is dealing with inventory, we have figures that are on the business records, and we also have figures that will come out of a physical stock count. A physical stock count figure will then be compared to the figure that appears on the business's book records. And the difference, therefore, will either give us a trading stock surplus or a trading stock deficit. So it is very important. The moment you just hear the physical stock count, the examiner is trying to tell you, you need to calculate either a trading stock surplus or a trading stock deficit. Let's see here what was there. But one thing of great importance is you can only calculate your trading stock deficit or surplus after you have considered adjustment A. So if you had not done adjustment A, this adjustment would therefore not be done properly. So you had to do adjustment A first before you can do adjustment B. You need to do adjustments in the order that the examiner has set them. Okay. In this adjustment, we enter figures in our statement of comprehensive income, and then we also need to take note of what we have already done, that is our inventory. Okay, so what we have done already is that we had our trading stock. We're just going back to what we just explained now. We had trading stock, which was how much? Our trading stock was 364,200. Okay, which is this one, 364,200. And we had a sale that we had not recorded. You remember what we just said a minute ago? Remember that 24,000? We just did that. Therefore, if we consider these two figures, that means according to business records, our trading stock figure, according to the business records, must be 340,200. 340,200. I've just taken the difference between these two. Okay, according to the business records, our stock must be 340,200. But we are then given a physical stock count amount. A physical stock count amount simply means we physically count our inventory. Then we found that our inventory amount is 334,500. So that means I'll come here and I'll have my 334,500. Okay, then if we then compare what we have on hand, which is 334,500, against what we have on paper. On paper, we must be having 340,200. But when we count physically, we only find 334,500. That simply means there is some stock that is not accounted for. Okay? How much is that? We say 340,200 minus 334,500. That is your 5,700. 5,700 becomes the difference. So once you realize that you have some stock that is not accounted for, that is what we then call our trading stock deficit. We then come under our operating expenses, then we will now say, I have trading stock deficit. Here is my trading stock deficit. And how do I know that I have trading stock deficit? I will then take my figure, which is my 364,200, 364,200. And then remember, I said minus 24,000, and then I'll say minus 334,500. And my trading stock deficit is this figure here, which is my 5,700. Are we good? Okay, so trading stock deficit is an expense. It simply means there is some stock that the business cannot account for. According to us, on records, we should be having 340,200 worth of stock. But physically, after counting, we realize, no, we don't have as much stock. We only have 334,500. What does that mean? There's some stock we cannot account for. We don't even know where is that stock. That becomes a trading stock deficit, an expense to the business. So that is why you find it under our operating expenses. Can I move on to the next adjustment? Thank you. Okay, the next adjustment is adjustment B. Okay, we are still there because we have now already dealt with our trading stock. But there is an aspect that is still coming here, which is what? Your consumable stores. All right, let us see what we're going to do. We are going to record consumable stores in our statement of comprehensive income. Remember, we are under operating expenses here. All right, so what we're going to do is we're going to come here and say, under my operating expenses, I'll say consumable stores. Consumable stores. The amount in the list of balances is 53,200. So I'll bring that one here, 53,200. However, we did not use all the consumable stores. There are some that are still left at the end of the financial period. That is what we call consumable stores on hand. Consumable stores on hand. These are consumable stores that were left over from what we had acquired during the year. So if it is on hand, we subtract it. Because in this column, we want to know the consumable stores used. An adjustment can come and say consumable stores used, your used figure becomes the final amount. The on hand will be subtracted. So I'll come here, then I'll say minus 3,400. We subtract the on hand. And then how much do we get? Calculators, please. 53,200 minus your 3,400. That is going to give you your 49,800. We good? Okay, let's move on to the next one. And then we know that once we have consumable stores on hand, we should record it in our inventory note. That is note number 4. So I'm going to come here at the bottom, then I'm going to say consumable stores on hand. Consumable stores on hand. And how much are they? That figure, 3,400. And our inventory note is finished. So the final figure here on top will become 337,900. Remember, this is what you then take to a statement of financial position. Okay, remember, what are we focusing on today? Statement of comprehensive income. But at the same time, you need to consider the statement of financial position, because in the next coming weeks, we're going to be doing the statement of financial position. Are we good? All right, I think we've now exhausted adjustment B. Adjustment B was split into two. Number 1, trading stock on hand. Number 2, consumable stores on hand. And with our trading stock on hand, we're able to calculate trading stock deficit, which is an expense. But if it was trading stock surplus, it was going to be income. You're correct. And then we also adjusted consumable stores on hand. Okay, let's go then. Here we go. We are now on adjustment C. Adjustment C. And it reads, debtor S Magnum was declared insolvent. This simply means our debtor is no longer in a position to pay up their debt. However, his estate paid 2,000. Okay, so his estate paid 2,000, which was 20% of his debt. The difference must be written off as a bad debt. What this tells us is this debtor, S Magnum, was owing us the full debt, which is 100%. In terms of rents, we don't know how much that was. We don't know. But his estate is now said, from the entire debt, the entire amount that this debtor was owing us, they will be able to pay, not the entire 100%. They'll only be able to pay what? 20%. They'll only be able to pay 20%. All right? 20% of that particular debt. And that 20% is now equal to the 2,000. That is equal to 2,000 in rents. Okay? Then they're telling us the difference here is what the examiner wants us to pay focus on. The difference must be written off as bad debt. When a debt cannot be recovered, it becomes a bad debt. So our focus, therefore, is on what remains from the 100% that the debtor was owing us, but was only able to pay 20. What is the remaining figure then that we cannot get? 100 minus the 20. So the amount that we cannot get here is the 80, because they have paid us 20. So we cannot get the 80%. We want to know in rent value, how much is that 80%? This becomes easy now. You remember, some call it the UK method. I don't know what you call it in your class. Some call it the Cremora method. Whichever way you call it. It simply means what you want or what you don't have, you take it to the top. So what we want in this case is the difference. The difference between the 100 and the 20. The difference is what? 80. Okay, so I will say 80. Then my have must have two values. One is a percentage, one is in rands. Can I go? So what I have is 20. So I'll come here, then I'll say 20. And 20 in terms of rands is how much? 2,000. Thank you so much. 2,000 rands. Let's punch that in the calculator. How much do you get? Thank you. All right. I hear someone saying, Mr. Simbi, I get 8,000. You are very correct. Then we take that 8,000. What does that become now? This becomes our bad debt. So we have to adjust it in the statement of comprehensive income, as well as in the statement of financial position. Let's see. In the statement of comprehensive income, we are now going to come and we're going to say bad debts. Bad debts. We had some bad debts already in the list of balances, which was your 22,300. We had that already. Then we're going to come and add this amount from S Magnum now, which is our 8,000. All right. So that simply means my total bad debts amount then becomes how much? 30,300. That becomes 30,300. But I know once I have a bad debt amount, it must be adjusted as well in trade and other receivables. So I'm going to come here and I'm going to say now debtors control. Debtors control. Okay? And it was 578,000. The examiner wants us to focus on the difference alone, just the difference. So that means from the 578, I'll come in, then I'll subtract the 8,000. That is what I would do when an amount is being written off. Can I move on to the next aspect? Let's go. The next aspect is adjustment D. Adjustment D. It says 1,800 rands was received from a debtor, J. Misting, whose debt had previously been written off. So we have a debt that was previously written off. That is a bad debt. Okay, it was written off as a bad debt previously. The bookkeeper now, so what happens is this debt was written off previously as a bad debt. And then this account has now been recovered. In other words, the person or the business has come now and paid up that money. So we have received money from an account that was written off. Are you following me? Writing off, what it means when we are writing off, it simply means this individual was part of our debtors, And when we write it off, he's no longer a debtor. When we write off, he's no longer a debtor because we have written it off. Now, this amount has now been recovered. Now, the bookkeeper incorrectly credited the amount to the debtor's control. So this bookkeeper does not know that the moment an amount is written off from your debtor's control, remember, we have a debit balance. We have a debit balance here in the debtor's control. We have a debit balance here. The moment an amount or an account is written off as your bad debt, we will not be able, that means it's no longer part of our debtors. What this bookkeeper then did is he incorrectly credited the amount to the debtor's control. This was done when the account was written off as a bad debt. We credited the account. When the amount gets recovered, it no longer affects our debtor's control because this debtor was written off previously. So he is no longer our debtor. So it cannot affect our debtor's control because he is no longer our debtor. But this bookkeeper incorrectly credited the amount to the debtor's control. So if an amount was incorrectly credited, now we are being told to correct the error. All right. When that happens, here are the accounts that get affected. When an amount is recovered from a debt that was previously written off, it affects two accounts, that is your bank, okay, and your bad debts recovered, which is your income. Two accounts get affected, not the debtor's control. So this bookkeeper did it incorrectly. The bookkeeper was supposed to record in these two accounts. However, they went on to the debtor's control, which is incorrect. So we are now told to correct the error. When we are correcting this error. Where we are going to go is first to start in our trade and other receivables. We will come and then we will now say that amount we are going to add it back, because when they credited, that means they were subtracting. They credited the amount, that means they subtracted the amount. Yet the amount was not supposed to be subtracted. What do we do to correct it? We add it here, plus 1,800. Now, what is the right way now to record this? This amount is supposed to be recorded in what we call the bad debts recovered. So we come here under other income. Then I will now say bad debts recovered. I'll open my bracket, and what do I start with? I'll start with the 6,000 that I have initially. Here's my 6,000. Then I'll now say, what do I now record? I'll record the 1,800 which we have received. So I'll come in, then I'll say plus 1,800 bad debts recovered. And obviously, we're going to now debit our bank. This is how we correct. This is how we correct. And here we're now doing the correct thing. And we also go and record in our bank account as well, because we have received money. When the bank account has a favorable balance, we're going to come and we're going to record in the bank account. Can I move on? Okay, I'm going to move on to the next one. The next adjustment is adjustment E. Adjustment E. Adjustment E. Adjustment E. It says, adjust the provision for bad debts to 28,500. Adjust the provision for bad debts to 28,500. All right. So you have to understand that when we create a provision for bad debts, we are saying there is a possibility that some of our debtors may not pay. Okay? So we create a provision now. And then what happens is, when we get the amount that is provision for bad debts must be adjusted to, if you attended last week's class, I also explained this aspect. When you have a provision for bad debts that has been adjusted to, that to amount is what we take to our note number 5. So this one, we take it straight into trade and other receivable. So we'll come here, then we say minus 28,500. My 2 figure comes here straight. Now, we know that in the previous year, we had created a provision in the previous year, which is 30,100. And in this year, we have also created a provision, which is 28,500. So what we are going to now say is, we're going to look at what we had in the previous year, okay? Then we'll now check what we have in the current year. In the previous year, we had 30,100. In the previous year, that is 2018. Previous year, we're talking about 2018. In 2019, which is this current year, we are having 28,500. What you see here is an increase or a decrease. Definitely it is a decrease. So once your provision for bad debts decreases, we consider it to be income. When your provision for bad debts decreases, we consider it to be income. The opposite therefore becomes true, which is if your provision for bad debts increases, it becomes an expense. Okay, so let's come here. So here we see a what? A decrease from 2018 to 2019. There's a decrease. And how much is that decrease? It is a decrease by how much? Calculators, please. 30.1 minus 28.5. 1,000, say it again. 1,600. 1,600. Okay, so that means I'll come here, then I'll now say provision, please write together with me, for bad debts adjustment. Okay, and then I'll say 30.1 minus 28.5. Then I close the bracket. Then I get 1,600. Can I show you one quick trick? Yes, I want to show you one quick trick. Are you ready for this? All right. Here's another way you can ascertain whether it is income or an expense. What about if you say, my old provision, yes, old provision, old is the previous one, old. So here you must have your calculator. Just have your calculator ready. Your old or the previous, your old or the previous. Here's my old provision. Here's my new provision. Can I go? Old provision, that is the previous year. New provision is this year. Old minus new. Old minus new. Then we trust our calculators. Can I go? Old minus new. Then we trust our calculators. So I just want you to take your calculator. Then you say 30,100 minus 28.5. How much do you get? 1.6. But you're not telling me something. Is that 1.6 a positive 1.6 or a negative 1.6? It's a positive 1.6. Once it's positive, it's income. You want me to say it again? Okay, I'm going to say it again. You are now going to say old minus new. And then you take your calculator. We call this the calculator method. Then you now say on your calculator, if my old minus new gives me a positive figure, once it's positive, it is income. That means the opposite is true as well. If you say your old minus new, it gives you a negative. That means it is an expense. Your provision for bad debts will be an expense, therefore. If your calculator gives you a negative, it's an expense. If your calculator gives you a positive, it is income. So I gave you two approaches here. The increase, the decrease. Then the second one, what did we call it? The calculator version. Trust your calculator. All right. Are we good? Let's quickly move on to the next adjustment, which is adjustment F. Let's go to adjustment F. We have done E, so the next one is going to be F. Here is adjustment F. Okay. Adjustment F reads, insurance includes an annual premium. The moment you just hear annual, how many months do you think about? 12. I like that. The moment you hear the word annual, you think 12 months. So insurance includes a 12-month premium of 51,000 paid for the period 1 January to 31 December. Okay, we now need to know, did we pay in advance? Did we pay less? The only way to ascertain that is to have a timeline. Let's have a timeline. Our financial period is ending on the 31st of March. When would it have begun? We spoke about this at the beginning of class. When would it have begun? It would have begun on the 1st of April. That means we're going to have April for which year? 2018. And then we stretch 12 months until when? The 31st of March. Okay, then here we're going to have the 1st of March 2019. These are 12 months. Okay, this is our financial period in this financial year. Our financial period. Now that we know this is our financial period, we are then told we paid insurance. And the insurance that we paid how much? 51,000. But it is for the period 1 January. So come here. And I'll say it for the period 1 January 2019. Okay? And it stretches over until the 31st of December. Which year? 2019. Okay. So our problem in this case is the period that stretches after March. The period that stretches after March, this one. You see that shaded area? That is our problem. We have paid in advance. How many months are those that we've paid in advance? So that means we count from here. That is going to be from when? From the month of? After March. What comes after March? April. So here we need figures. We're going to say April, May, June, July, August, September, October, November, December. How many months do we get? 9. So our problem is the 9 months that we've paid in advance. But we are told it's an annual. We agreed how many months? Annual? 12. So it'll be 9 over 12. Then we multiply that by how much? By 51,000. We multiply that by 51,000. I need to see calculators. How much do you get? Say it again. 38,250. I like that. 38,250. What is this? A prepaid expense. An expense that we've paid in advance. When we've paid for an expense in advance, in our statement of comprehensive income, we will come and then we will say insurance. And then we'll open our bracket and we'll say 79,500 minus, because in the 79.5, it includes this 51. Did you get that? This amount, it includes the 51,000. So we now say 79.5 minus our prepaid expense. Remember, in the statement of comprehensive income, what do? We subtract prepaid expenses. Then we say minus 38,250. I need to see calculators. This minus that. That's 79.5 minus 38,250. How much do you get? 41,250. Do we record this in the statement of financial position? Definitely we do. All right. So in the statement of financial position, what do we record? Would come here. Remember, we're doing with our debtors control, but now we're going to come and record what we call prepaid expenses. We're going to say prepaid expenses. Open bracket. How much is our prepaid expenses? That's 38,250. Are we good? Okay, I'm happy to hear that. Can I move on to the next aspect then? Thank you. Let's move on to the next aspect. My next aspect is adjustment G. Okay, I love this one because it is a very common adjustment. Examiners love this adjustment and they love doing it in different ways. If you check last week's activity, you need to revisit last week's class and see how this very same adjustment was brought in. Okay, so you can check last week's class and see how the examiners brought this adjustment. In this week, it comes and it says, an employee was left out. That means this employee was not recorded. In my mind, I have to know that if an amount is left out, an employee is left out, I must then go and add it because he was left out. I must record him. Was left out of the salaries journal for March. The following details are applicable. Net salary of the employee, 9,100. The deductions by the employer total to 30% of the gross salary. The employer's contributions were 2,200. Let us see. Okay, so we know that this employee must be paid, okay, his salary, but there are figures that were not recorded. Gross salary, our gross salary, in this case, is our 100%. That's our gross salary, the entire salary, 100%. But how much is it in rands? We don't know. If we were given the gross salary, we would have just recorded that gross in the statement of comprehensive income. So in this case, we need to get the gross so we can record it in the statement of comprehensive income. Okay. And here we don't know how much is that gross. But what we know is that when we take our gross, then we say minus deductions. Gross minus deductions. And these deductions, we are told it is 30%. So it is gross minus deductions, and these deductions are 30%. Do we know the amount for these deductions? We don't know the rand value either. We are not given. But what we know is that gross minus deductions, it is equal to net salary. Do we know the percentage of net salary? Simple. Gross minus deduction. That gives us what? 70%. That becomes your net. And we are then told the net salary of the employee is 9,100. That is in rands now. So we can come here and we then say 9,100. What do we want? In the statement of comprehensive income, we record our gross. What do we want? We want the 100. What do we have? We have 70. Multiply that by the 9,100. How much does it become? Calculators. How much do we get? Thank you. Someone says, Mr. Simbi, that's 13,000. That is very true. So we get 13,000, which is our gross. It therefore means I will come now to my statement of comprehensive income under my salaries and wages. And I'll say salaries, please write together with me, and wages. I open my bracket and I'll say 1,280,000 plus, because a salary was not recorded, plus the 13,000. That's what I would do. I've recorded my gross salary. That's the 13,000. And after that, I would then consider my employer's contribution. So I only look at the contributions after I am done with my gross salary. Then when I come to the employer's contribution, I now know that this one will be recorded under my employer's contribution. So I'll come in, then I'll say employer's contribution. Employer's contribution. And my employer's contribution, let's open bracket. In the list of balances, I'm given 316,000. So I come here, here's my 316,000. And the contributions are 2,200. What do I do? I add it. Thank you. So I come and say plus 2,200. I add these contributions that were left out. I add them. Okay. So what did you see? Under your salaries and wages, what do you record? Gross. And then the contributions would then go to your employer's contribution. However, you need to check at times. The examiner will say the contributions will be debited to the salaries account. That simply means you take your contributions and you add them to the salaries. But in this activity, we were given a separate employer's contribution amount. Okay. Once we do that, let's quickly close the brackets. So we're going to end up here with 1 million. How much you get? All right. 1,293,000. 1,293,000. Then we add these two figures. That gives you 318,200. All right. And then we are now going to do one last adjustment before we go for a short break. So we're going to do this adjustment, which is adjustment H, and then we're going to take a 5-minute break. Adjustment H reads, interest on loan is capitalized. A fixed monthly repayment, including interest, of 25,400 was paid for the financial year. So what they did in this question is, we're given the loan amount for the previous year, which is 1,658,000. And then the loan amount for this year is now 1,430,200. That simply means we have made some repayments to the loan. The difference between the two amounts becomes the repayment to the loan. How much is that? That simply means I'm taking my 1,658,000. I will check the difference between the 2018 loan and the 2019 loan. The 2019 loan is 1,430,200. And that amount is, calculators, you get how much? 227,800. You get a 227,800. That is the difference between the loan amounts. That means we have made repayments of 227,800 of the loan amount. However, we have been told that interest on loan is capitalized. That means interest on loan is added to the loan amount. And we are making monthly repayments. Every month we make repayments. And these repayments include interest. That simply means it is my 25,400 monthly. I multiplied by 12 months because this is for the entire year. How much is that going to give us? That is going to give us an amount that is 300, say it again, 304,800. 304,800. So for this year, the total payments that we have made are 304,800. But these payments include interest. So in the 304,800, there are two things. It is the loan itself that we've been paying and interest as well. Two aspects that are in the 304,800. Two aspects. The loan itself together with interest. But we know the loan amount. How much is the loan amount? 227,800. So if we come here, then we say minus 227,800. We want to find out how much is the interest, because in the 304,800 is two things, the loan and the interest. So if I know the loan, I can get the interest then. How much is that interest? Please shout it. 77,000. Thank you. 77,000. So I now know my interest. That means I can now come to my statement of comprehensive income. Then I'm going to say on my interest expense, I would then say my interest expense is 77,000. Then someone says, Mr. Simbi, how would I show the calculation? Because calculations are very important. This is how you would show your calculation. You would then say the 1,658,000, which is in 2018, 1,658,000 minus the 1,430,200 minus the 304,800 minus the 304,800. That would then give you the 77,000. That is your interest expense. We are going to take a quick 5-minute break. After this break, we're going to conclude this statement of comprehensive income. See you in the next 5 minutes.
Excellence. Excellence is a habit. Excellence is a quality you have, a quality I have. It's a quality we have when we honor what is true to us. Yes, we are gifted differently. uNkulunkulu akasinganga ngokufana. Excellence is striving for your best. Whenever you have a particular project, test, homework, uzibuze, ask yourself, is this my best? Can I put in more effort? Excellence is striving to be in the top 1% of the area in which you are gifted. And so I challenge you, in every single thing that you do, in every single area that you're gifted in, whether it's sports, it's academic, ucula, whatever that gift is, strive for excellence.
Welcome back, dear learners. Before the ad break, we did some interesting adjustments. I think you can remember. Then here is one of them, which was on the interest on loan. Okay, I'm going to move on now to the next adjustment. Here is the next adjustment, which is I. Okay, so some of you might say, I have a problem with the depreciation. Whenever I see depreciation, I freeze, or I'm scared of depreciation calculations. Make sure that you attend these classes consistently, so because we're going to be attacking some of these challenges. We're going to be addressing most of your problems in these classes. Okay, so here what we have is an extract of figures from the pre-adjustment trial balance. We have our vehicles, and then we've accumulated depreciation on vehicles. And then we're told that vehicles are depreciated at 20% per annum on cost. It is very important that when we calculate depreciation, you know exactly what is the rate and the formula, and that is the method of depreciation that is being used. Here, the rate is 20% on cost. That means they're using the cost price method, the fixed installment method, where you calculate your depreciation on the cost price. Okay, now we are going to calculate depreciation. But before we do that, remember that when you calculate depreciation, you calculate it for your son. Do you remember what the son stands for? The S stands for the sold, the O stands for your old, and the N stands for the new. So you always calculate for your sold, your old, and your new. That is what you calculate depreciation on. Let's go. We are told here that we have three separate vehicles. Three separate vehicles. The first one is vehicle number one. Vehicle number one. Let's look for vehicle number one. And our vehicle number one has a cost price of 350,000. Accumulated depreciation on this vehicle is 315,000. You know that if you take your cost, then you say minus accumulated depreciation, it will give you what is known as what? The book value. All right? I'm going to call it the CBV, carrying book value. So if I take my cost of 350,000 and I subtract my accumulated depreciation of 315,000, I will have my CBV. How much is that on your calculators? Thank you. Of 35,000. That is my carrying book value. Let's now go and calculate depreciation. I know that if I'm calculating it on cost, I have to take the cost price. That is my 350,000. Then I say multiplied by the rate, which is my 20 over 100. For how many months did I have this asset? I have had it from the 1st of October, 2018. That is way back in the past. So this vehicle has been there all these years. So that simply means we have had it for 12 months because we have not been told if this vehicle was sold. So we still have it. So it's 12 over 12. Let's punch that in the calculator. How much becomes our depreciation for this year? How much do you see on the calculator? 70,000. Thank you. You see 70,000. Okay. This 70,000, is this the correct depreciation amount? Certainly not. Then you're asking, Mr. Simbi, how can it not be? Because I have said 350 times 20% times 12 over 12, it gives you 70,000. That is very true. However, we have carrying value to the value of 35,000 only for this particular asset. So this particular asset has a carrying value of 35,000. Therefore, it cannot lose more due to depreciation more than its carrying value. If its carrying value is 35,000, therefore it cannot lose more. In other words, if we take the carrying value minus 70,000, we're going to have an asset that is already in the negative. It cannot be negative because it is an asset that is still in existence. Physically, it is existing. So our asset can never have a negative value. Then you're thinking, okay, let it just lose the 35,000. No, it cannot lose the entire 35,000 because that means the asset will end up with what? 0. That means once we get to this point whereby our depreciation is more than the carrying book value, we will lose that 70,000 that was depreciation. And then we take the 35,000 and now say, we have used this asset, it must lose value, but it cannot lose more than its carrying value of 35,000. So it can't lose 70. Let it lose something, but we must remain with something to record in our accounting books. Okay, what we want is to remain with a figure that we can show in our accounting books. And because this is one vehicle, we will now apply the 1 rand principle. The 1 rand principle. What that says is, let the asset lose value, but let it remain now with 1 rand, so then we can record it in the business books. So what it means is, I'll come, then I'll say, if I say my carrying value minus my depreciation, I have to remain with 1 rand, the 1 rand carrying value. I have to remain with 1 rand as the carrying value. So that simply means if I take my 35,000 and I subtract my depreciation, I must remain with 1 rand. How much, therefore, is my depreciation? You then get what? 34,999. 34,999. That becomes my depreciation. So my depreciation was not 70, even though that is what I got from the calculator. But it will become 34,999. Reason being, the 70,000 is more than my carrying value of 35,000. So when I come here now and I'm recording my depreciation, I will then say depreciation. I open my bracket and I'll record my 34,999. How do I know that I must apply this 1 rand principle? First, the examiner will give you a calculation using the cost price method. This is number 1. Number 2, when your carrying value is lesser than your depreciation, 2 things I've given you. Can I repeat them again? Number 1, once you see the cost price method, start to think the examiner might be trying to test me on the 1 rand residual value. Number 2, when you see that your carrying value is lesser than your depreciation, that is after you've already calculated. Let's go to the next adjustment. In the next adjustment, we're now going to calculate. Remember, we've calculated for vehicle 1. So we're going to calculate now for vehicle number 2. Vehicle number 2, what is its cost price? 400,000. And then, what is the depreciation rate? 20% per annum on cost. Multiply by 20 over 100. And this vehicle was there since 2016. So it was there for 12 months. By 12 over 12. How much do we get? Calculators? Thank you. You get 80,000. So I get here my 80,000. This one was a simple one. Okay, so let's come and we're going to add our 80,000 plus 80,000 plus 80,000. Simple one, this one. Yes, this one was a simple one. Let's go on to the next one, the third one. Remember, we have 3 vehicles. We've done the first one, the second one. Let's go on to the third one. The third one then, its cost price is 627. Remember, now we're on the third one. You can see it was bought on the 30th of November. So this is a new vehicle. Its cost price is 627,000 and the depreciation rate is 20% per annum on cost. And it has been in the business from the 30th of November. So if we're counting from the 30th of November, remember the financial is ending 31st of March. So if it's from the 30th of November, do we count November? Certainly not. What do we count from? December, January, February, March, and then the year ends. How many months do you see there? 4 over 12. I need that calculator close, guys. How much do we get? Say it again. Then we get 41,800. Then I get my 41,800 over there. So with that 41.8, that becomes my depreciation. What was the trick here? The examiner gave you 30 November. If you count November, you're going to get 5 months. That's wrong already. Once you see 30 November, or if the examiner gives you what? 1 December, then you count from December. Are we good? Okay, let's go on to the next one. That means now I need to come here and say plus. Plus how much? Plus my 41,800. Are you following? Thank you, thank you, thank you. Let us now come and say, now that we have all the 3 depreciation vehicles, okay, the 3 depreciation amounts for the 3 vehicles rather, we have for vehicle 1, vehicle 2, vehicle 3. Let's bring it here now to our note number 3, tangible asset note. Okay, our tangible asset note is split maybe into 3 parts. We have the first part, which is the top part, which is this part, part number 1, where you have your carrying value, your cost, and your accumulated. Then the second part is your movements, where you have your additions, disposal, up until depreciation. And then the last part is this part as well. So 3 parts of your note 3. Okay, let's come here. On our additions, do we have a new vehicle that was bought this year? Yes, you remember that one that we last calculated depreciation for. How much was that? 627. All right, that is your 627. So we're going to come here. Our additions is 627. Our additions is 627. That is our additions. Do we have any disposal at carrying value? No. Okay, we do not dispose any asset. Now let's come to our depreciation. Remember, we've already done depreciation calculation for the 3 vehicles. Remember, this one was the first one, vehicle 1, vehicle 2, vehicle number 3. And if we add these figures, I want us to add these figures, how much do we get? If we say 34,999 plus 80,000 plus 41,800, how much becomes the total? 156,000. Say it again, 156,799. Thank you. So that means when I come here, I know in my depreciation figure, I must have bracket here. And in my depreciation, I must show it for the 3 vehicles. The first vehicle being 34,999. The next vehicle being the 80,000. And then the last vehicle being 41,800. I like this one. How much is the total? It's given there. 156,799. This is in our statement of comprehensive income. Okay, and then this comes here. I have put the total here because I just wanted to show you here. Okay, but this will not be the total figure because we still have more assets to consider. These were vehicles. We would have the total figure here after we are completely done with our equipment. But I just wanted to show you how that 156 comes here. Okay, so we're still going to continue with this aspect here because we still have to consider our equipment. Are we good? So let's complete the bottom part. If we are to conclude the bottom part, we now need accumulated depreciation because we have cost already. And for us to get our accumulated depreciation, what do we say? We will now say our accumulated at the beginning, which is 475, plus depreciation, which is 156,799. If we add those two figures, how much do you get? Let me say it again. It is your 475,000 here plus the 156,799. That will give you 631,799. Thank you. And to get now my carrying value, I'm just going to take those two, then get the difference to get my carrying value. How much is that carrying value? 745,201. 745,201. That becomes my carrying value at the beginning of the financial year. Then note number 3 is completely done. This is what pertains to the vehicles. Let's go to the equipment. Okay. We are told on equipment that we have equipment in 2018, which is 398, and is the accumulated depreciation. And the 2019 figures have not been given, so we need to calculate some figures here. Equipment was sold for 9.6 on the 31st. So here we have a disposal now. Remember the sun, sold, old, new. So now we're going to deal with the sold. In the previous, we had the old and the new. Remember when we did with the vehicles, with the old and the new. Now we're going to deal with the sold. So we are told that we have equipment which was sold for 9,600 cash. This is what we got from selling this equipment on 31st of August 2018. Only the following entries were made in respect of the sale processed. The cost price was 28,000. So we know that this equipment had a cost price of 28,000. That was its cost price, 28,000. Let me continue. Accumulated depreciation at the date of disposal. Very important. Accumulated depreciation, not at the beginning of the financial year. Because in some question papers you would find they'll say accumulated depreciation at the beginning of the financial year. But this is accumulated depreciation at the date of disposal. That simply means the depreciation for the year when this asset has been used is already added in there. Very key, very key. So if I take my cost, then I say minus accumulated depreciation. And my accumulated depreciation is 21,500. If I subtract that, that's going to give me the carrying value of the asset at the date of disposal. 28,000 minus 21.5. Let me repeat again. Within the 21.5, it is the accumulated depreciation from the date we acquired the asset until the day we are disposing it. And the depreciation for the year, depreciation for the current year, which is 1,750, is inside that figure because it is at the date of disposal. So I can get my carrying value then. How much is that? 6,500. That becomes my carrying value. Okay, I want to go. If I know the carrying value of the asset that I've disposed, yet I've sold it for 9,600. I've received 9.6. Yet this asset was worth 6,500. Worth, I'm talking about the carrying value. The carrying value is the worth of the asset. Okay, let's do this again. I have sold it for 9,600. Yet it was worth 6,500. Did I gain? Did I lose? I sold it for 9.6, yet its value is 6.5. Did we benefit or did we lose? Certainly we benefited because we sold it for 9.6, yet it is only worth 6.5. How much did we make as profit? The difference between the two becomes 3,100. So what do we then call that? Profit on sale of asset. So I'm going to come to other income. Then I'm going to say profit on sale of asset. Profit on sale of asset. How much is that? 9.6 minus 6.5. How much profit did we make? 3,100. We made a profit of 3,100. The depreciation, we are covered already. What did they want us to calculate? The profit on sale of the asset. So the depreciation, we're going to go and add it to the depreciation that pertained to our vehicles. You remember? We're going to take it there. Okay. Let me quickly move on to the next part. And the next part, therefore, that we're going to be dealing with now is the recording of my depreciation. Okay, so I'm going to come here and I'm now going to say, here we're told, depreciation on the remaining equipment. So that means we have two now. We have depreciation of the sold, which is 1,750, and we have depreciation for the remaining, which is your 92.5. So I'll come here, then I'll say plus my 1,750 plus again the depreciation of the remaining, which is 92,500. Those are the two depreciation amounts. That becomes 251,049. 251,049. Okay, may I move on? Thank you. I'm going to move on to the next aspect. Already you know which is the next aspect that I'm going to move on to now. It is going to be your note 3. All right, so in your note 3, here we have the first part. This we know that was done already. Additions, did we have a new asset? No. Disposal at carrying value, they are simply saying, what was the carrying value of the asset on the day you sold it? We calculated that one already. What is the carrying value of the asset on the date we sold it? Okay, how do we get that? We know that the asset had a cost price of 28. It had a cost price of 28. On the date of disposal, it had lost 21.5. What was its carrying value? And disposal on carrying value must be in brackets. And that amount is 6,500. So disposal at carrying value, they simply say, what was the carrying value of the asset on the day we sold it? That's what they are asking for. Then depreciation was given already, 94,250. Do you remember how we got that one? It was depreciation for the sold, 1,750, plus the depreciation of the remaining, which was our 92,500. Then we'd close it. That is how it would give us that one. Let's come now to our cost. We'll now say 398,000. That is the cost price of the asset. And then, did we sell any asset? Yes. So we would say 398,000 here minus the cost price of the asset we disposed minus 28,000. Minus 28,000. That will give you how much? 370,000. 370,000. 370,000. That gives you the cost price. On accumulated depreciation, we would now say, what was the accumulated at the beginning? That was 117,500. Then we would say plus 94,250. Okay? So we would say 117,500 plus the depreciation for the year, 94,250 minus the accumulated depreciation of the asset that we have disposed, the 21.5 minus our 21.5. How much do you get on your calculator? 190,000. Say it again. 190,250. 190,250. And then let's quickly get now our carrying value at the beginning of the year. That is going to give you 179,000. 179,750. Okay. I think we're sorted so far. Are we good? Okay. So we have done now depreciation calculation for our vehicles as well as our equipment. We have also completed note number 3. Okay, I'm going to move on from here. Our next adjustment is adjustment J, which pertains to interest income. They say interest income is the missing figure in the statement of comprehensive income. So I need this figure here. That is my interest income. And for me to get that interest income, what do? That should be very simple. For me to get my interest income, I'll simply say my 768,000 minus my 742 Okay, so I'm simply subtracting this and that figure, and then it will give me how much? It gives me 26,000. It gives me 26,000. So that if I say that plus that, it should give me this figure here. It should give me that one. Are we good? Okay, this one was a giveaway. This one was a giveaway. Let's go on to the next aspect. Now we are going to look at our income tax. Income tax is calculated at 28% of net profit. 28% of net profit. The net profit before tax was calculated at 691,000. Okay, so our answer book in most cases is given in this way. And at times you get an answer book and it's shaded. I'm going to show you next week. Do not write in the shaded areas. The shaded areas are not for you. You should always leave those areas out. Okay, so here we should get our net profit before tax. So how do we get net profit before tax? 768 minus the 77. Remember we got the 77. Then that will give us how much? 691,000. 691,000 here, which we are told is the net profit before tax. Net profit before tax is 100%. Okay? Last week I explained this. I want to encourage you to be consistent by attending these classes. Net profit before tax was 100%, and we're told that income tax is at what? 28%. Income tax is at 28%. Therefore, my net profit after tax becomes 72%. What do I want? I want to get my income tax. So I'll now say I want 28 over, what do I have? Over 100. Multiply this by 691,000. How much does that give you? That gives you 193,480. Remember, this amount must be in bracket because that is your income tax. That should then give you net profit after tax. How much is that? 497,500. 497,520. Okay, thank you. Someone is saying that's 520. 497,520. Okay, let's make that 497,520 over there. 497,520. That's your 520 over there. Okay. 497,520. All right. We're going to look now. So your statement of comprehensive income is complete. Then we're just going to look at the next aspect, which is your ordinary share capital note. This is going to be our last aspect in today's class, and then we're going to call it a day. All right, here is our ordinary share capital note. Remember, we touched this in the very first week. Okay, we touched this, I think, in the previous class as well, and we're going to touch it again in this week's class. Here we're going to look at our ordinary share capital note, that is note number 7. The first thing that you have to know is that here we're going to deal with what? Issued. Okay? Then we are told that in 2018, the ordinary share capital was what? 4.8 million. That means I'm going to come here and I'm going to say, this is 4,800,000 here. But what is that? This is our shares in issue. That is at the beginning. Okay, so I'm just going to say on the 1st of April, that is 2018, on the 1st of April 2018. And then at the end, we get this balance that is for 2019. So again, it's going to be shares in issue on, or at the end. Let me just say at the end, or you could have said on, that is 31st of March 2019. 19. Okay, so here it's going to be 9.3 million. 9.3 million here. 9.3 million. So I've taken my opening balance right at the top and my closing balance right at the end there. These ones were given. So this one was a very easy one. The company is an authorized share capital. Remember what is authorized share capital? The maximum number of shares that a company is allowed to issue to the public. They have not yet issued the entire 8 million. They are allowed. They can issue 8 million. But you would then be told the company had issued 1.2 million shares on the 1st of April. So I'll come here on the 1st of April. I have 1.2 million shares on issue. Okay? You still with me? Okay. Then we're then told 150,000 shares were repurchased. 150,000 shares were repurchased. Once I begin to hear about repurchase, I come and I put brackets. Then in my mind, I need to calculate my average price. You remember the triangle? I calculate the average price. Here at the bottom left side, okay, or on my side it is on the left. I'm not sure about your side. Here is the average price. Okay, that is what goes to note number 7. How do I get that average price? I would say my 4.8 million, which is this one here, 4.8 million, I divide that by my 1.2 million here, 1.2 million. That will give me how much? Thank you. That gives me 4 rand. That becomes my average price. So I'm going to bring this here, 4 rand, 4 rand. Can I go on? So I'll then come here and say, how many shares were repurchased? 150,000 shares. 150,000 shares were repurchased. At, I record here the average price, 4 rand. Okay? And then that will give me how much? 600,000. That will give me 600,000. That is what I record here. I know I'm told that it totaled to 825,000. That 825,000 is what goes to my bank. Others would call it the cash flow amount. Okay, that is where we take the 825,000. Remember, you can also get the price per share. All right, and then the difference goes to your retained income. Remember here, I just brought in the total amount. If I wanted, I would have brought the 600,000 here so that you can see 600,000, 825. And in the retained income, you take your what? Your 225,000. If you're dealing with the entire amounts. Are we good? Okay, so here we have repurchase shares at 600,000. Let's go on to the next aspect. Then they say 150,000 shares, okay, were repurchased. Remember, we did that one. And then the last part then says 850,000 additional shares were issued. So I'm going to come here and I'm going to say 850,000 shares were issued. 850,000 shares were issued. We don't know the price at which they were issued at, so we need to get that one. Okay, but for us to get that one, first we need to close this part. So I'll say 1.2 minus 150 plus 850. How much do you get? You get 1,900,000. 1,900,000. So first we'll do this part so that we can get this amount there. Once we get our 1.9 million, then we can come here and then we do the bottom up calculation where we now say 9.3 million plus 600,000 minus 4.6 million, 4.8 million rather. 9.3 plus 600,000 minus 4.8. How much do you get? 5,100,000. 5,100,000. Okay, I had this extra line here, but it was not going to be used. Okay, I hope this makes sense to you. So at the end of the day, this is my note number 7. In this case, we had a balance at the beginning, we had a repurchase, and we had an issue. And then we had our balance at the end. All right. It is very important, dear learners, that whenever you attend these classes, bring your calculator. I always say this, calculator, pen, and paper. But above all, I need your mind here in class, and I need you to perform particular calculations. We're going to be meeting every Friday at this time. You need to start telling your friends that there is classes that are taking place. It is of benefit that you attend these classes. Next week, I'm going to be explaining again other complex and interesting adjustments. I need you to attend these classes, and I need you to be following when I'm doing the calculations. We've come to the end of today's class. It's been lovely having you in my class. I really enjoy having you in my class. And I look forward to seeing you again next week. Same time, 2 o'clock, and then we start. Until next time, it is goodbye.